The US Treasury market remains the world's deepest and most liquid government bond market.
The other observation is with the so-called smile of the US dollar. This smile has somewhat disappeared. Welcome to this lunch talk. The world is changing. We have geopolitical shifts in the global economy. That has repercussions on financial markets, and sovereign bond markets are the backbone of the financial system. That is why it's a great pleasure today to talk about the current state and the future structure of sovereign bond markets in the US and in Europe with Darrell Duffie. Darrell is the Adams Distinguished Professor for Management and Finance at Stanford University. He works as an academic for more than 40 years on financial market topics, credit risk, risk management, financial infrastructure, and financial regulation. So he has a long-term view on the big changes in the system, and I'm very happy to discuss that topic with him. Hello, Darrell. Great to have you here at the lunch talk with me. These are very interesting times, and many people describe them as a perma-crisis, as a multiple crisis. And if you look at the global setting, we have the Middle East conflict, but the Middle East conflict is part of a more general shift of the global political economy being readjusted. And we know that in those episodes, the financial market rests a lot on also sovereign bonds and sovereign markets as a backbone. You are in the business for decades. You have observed that markets, the US Treasury market, for decades. What is your grasp of the current state of the US Treasury market, and maybe also your view on the European market?
That's a terrific question, Rolf. A good day, and it's a pleasure to be with you here. Amidst all of this geopolitical volatility that you described and the events of the last few years, we have the backdrop of an enormous issuance of sovereign bonds by almost all large issuers. That's the most important factor in understanding how sovereign bond markets are working. But the US Treasury market remains, despite everything, the world's deepest and most liquid government bond market. The issue is the degree to which the Treasury can continue to issue high volume and have the current market structure handle that, while all the other sovereigns are also issuing enormous volumes.
That's an important point. So we go to the specialness of the US Treasury market and what it actually means. I mean, for me, there is a bit of a divide sometimes in that discussion, because if you talk to the political scientists and the policymakers, yes, the world is shifting. If you talk to the finance guys, it's basically the views, yes, but the US dollar is what it is and nothing changes. Is it really true that there is no change in the specialness of the US dollar? I mean, if you look in detail, we do obviously also look in detail into that situation, and we do think that there is changes in hedging behavior. You see drives towards diversification, and you see kind of changes in what people call the convenience yield, which is the added value of holding a US dollar beyond the simple pricing, so to speak, that you normally have. Do you see those things, or don't you?
Absolutely. There's been a very important reduction in the willingness of official sector purchasers of US Treasuries. Now gold is an even larger fraction of foreign exchange reserves than US Treasuries, and the fraction of US Treasuries held in the official sector of total US Treasury issuance is at its lowest point since the turn of the century. It's no longer as dominant as it was, but if you look to the next most important currency and bond market, it's the euro market, of course, and it is growing in terms of its importance, but there's no question at all that the US Treasury market is still the leading global bond market. It's still a safe haven in terms of when we hit these geopolitical events. It's still the go-to safe haven. It's still the deepest and most liquid market in the world. And the underlying position of the US dollar as a currency is still dominant in the foreign exchange market, in trade invoicing, cross-border payments. The US dollar is by far and away the hegemon of global currencies.
I mean, the hegemon means also that it's indeed the institution that keeps things together. That's the definition of a hegemon. I mean, from what you say is, for example, if you look at the recent episodes when US policies led to market uncertainty and volatility, and here we're specifically at the episode of the liberation day announcement, but also at the start of the war with Iran. In our view, markets behaved somewhat different than they did in the past, in a sense that, yes, you actually saw flows and prices moving in a way that gave more risk to US Treasuries than they did to bonds. So that in that regard, at least, yes, we cannot change the structure from today to tomorrow, but indeed market behavior is adjusting. The other observation is with the so-called smile of the US dollar, in a way, has somewhat disappeared. The smile meaning that the US dollar exchange rate is basically strong when the world is in dire straits, because that is where you go and because you need the payment role of the US dollar. At the same time, it's also strong when the US is strong, because it's just the economy is doing well. Well, now we see in markets being much more cautious and much more hedging against the devaluation of the dollar. So this smile has somewhat disappeared. So we cannot change the structure, but over time that may lead to movements. Is this also something you would predict, or you think it's just kind of, it's so cemented that this is at the margin?
It's not at all cemented. There's been a gradual erosion. US foreign policy, US tariff policy, these have all caused erosion and the degree of reliance on the US dollar itself and US Treasury markets. So it's all a question of degree. If Germany, for example, were to become a much bigger spender and to increase the size of the Bund market by an order of magnitude, that would of course benefit. Until there's a Eurobond, it would become the benchmark for global bond markets because it's higher quality in terms of credit than the US Treasury.
That's a fair point, but I think for Germany alone it would probably be too much. It brings up an important point about the fiscal position, where people are getting concerned on how deficits also in the US may play out in the long run, at what stage credit risk actually prevails, also in the view of market of investors. Is it a real concern? I think we see something in pricing of treasuries, but you think so far, or as far as we can say for the moment, given the exorbitant privilege of having this deepest market, this holds, and this for the foreseeable future will hold?
This privilege is not to be taken for granted. U.S. debt to GDP around 100%, highest since the Second World War, and matching the 100% debt to GDP at that time, is an enormous burden on the U.S. fiscal balances. Its interest expense is huge, and there's no end in sight of these deficits. The issue is, how much fiscal space does the United States have left? My view is, unfortunately, they can dig the hole much deeper. We don't know how deep, until the bond vigilantes come out of the woodwork and really cause a rejection of U.S. Treasury markets or yields jumping way higher on credit risk. That's partly a function of the underlying strength of the U.S. economy, which is unexpectedly very resilient to all of this.
And now people having big hopes on AI as kind of basically rescuing.
And also, the experience of other countries is that you can dig a very deep hole before markets will actually reject your bonds.
One point that you bring up, which is evidently an important point more for Europe, is the depth of the European market and the availability of European safe assets. There are different approaches out here, and politically it's very controversial. Some people say if you really want to replace the Treasury, you need to go big, which means you need to kind of basically make past debt a common European asset in order to go there. Other people saying, no, we rather do this forward-looking for financing of future public goods. And what we need is a permanent presence of Eurobonds in the market in order to set the benchmark. I mean, if I listen at you, you would be siding with the first approach if the euro really wants to increase its international role, or do you think forward-looking would be good enough?
It's going to be a very slow incremental process, in my opinion, but eventually Europe is going to have something approaching a capital market union, and this is going to take decades, in my view. It's going to be very incremental, and a necessary condition for Europe to rival the dollar as a benchmark for safe haven for global investors is that there is a safe euro area bond, and How that's going to be done remains to be determined. I think it's going to be very incremental because of divergences of incentives and views within Europe. It's going to happen. I think it's inevitable, but it's going to take a long time and move in small steps. Some of the work you're doing here at ESM is contributing to those steps. I think it's going to take some creative thinking to create a euro area bond in size.
Absolutely. So I mean, we are part of those institutions that actually issue European safe assets next to the European Investment Bank and next to the European Commission. At this stage, there are roughly 1.5 trillion out there, which is already a pretty sizable number that many people wouldn't have thought of in the past that it would happen. I think from my perspective, that's one part of it. And I think also forward-looking, there's more scope, even if you are not in the camp of those people that feel that past obligations should be kind of mutualized, but also if you only think about future financing of common public goods, there is indeed scope for thinking about European financing where it makes sense. But next to this, what is also very important for me is the action that the ECB has taken. And here also the ECB is more vocal, more proactive in also supporting a strong international role of the euro, which is actually a remarkable change in stance. And in that regard, they have also opened up in order to support that role by broadening their collateral framework as one of the points. They are also engaging with on payment systems with other economies. If you have to balance that, because, I mean, part of your expertise is related also, a big part of your expertise is related to payment structures, to market infrastructure. Is it both part of the same picture? Do you think what ECB does is equally important, more important, or is it kind of categorically different?
It's critically important. The ECB has a lot of influence on the structure of payments and also on liquidity provision within Europe that can create greater and greater financial integration in money markets and bond markets. You mentioned collateral frameworks. The ECB can use its ability to design collateral frameworks in order to promote euro-wide baskets of collateral that will emulate what might eventually be a very large move towards Eurobonds. For example, it could accept standardized baskets of European sovereign debt across the Eurozone that would become effectively traded portfolios of packages of European sovereign bonds, much like what a Eurobond would look like. And that would be one of these small steps towards standardization. The ECB is also on the move with Project Pontes and Project Appia to promote the use of central bank reserves as the cash side of tokenized finance for sovereign bonds. And that would be putting the euro a step forward ahead of the dollar in terms of public market infrastructure for digital finance.
And let me put this a bit into the broader context. It's very important that you mentioned this. So Pontes Appia is part of the infrastructure that is created also to launch the digital euro, or the so-called CBDC, central bank digital currency. Okay. And but here, I mean, if you take the broader picture, it is very interesting because Europe is embarking on a structurally different way than the US. The US has so far clearly excluded the launch of CBDC, and they will be building on stablecoins as private money. We will see being the backbone of the system, or at least this is the avenue they want to take, while the ECB, the Europeans, it's a broader European project, and it's also in a way highly political, that we must recognize, and has received broad support from the political sphere. So it says we want digital currency to be the backbone of the system. If you look at those two approaches, I mean, and what you currently said, you seem to be of the view that actually having that central bank digital money may be a strategic advantage. Is that the right view?
With respect to the wholesale financial markets, Project Pontes and Project Appia will make a big difference in terms of the eventual efficiency of the sovereign bond market and more generally of financial markets, infrastructure, payment systems. But that's the core of financial markets. The digital euro that we all read about every day in the newspapers is a retail payment system. It's been designed not really as a medium of exchange or store of value for financial markets. It is a very big flag that Europe is waving for advancement of the euro, and it also is it's going to, I think, make a difference in retail payments. You mentioned stablecoins. That's not really going to be effective in the US payment system, either at the retail or at the wholesale level. And there are other moves that the United States is making in this area.
That's a very interesting assessment, because many people think it will or it should. Why do you don't think that there will be demand for stable coins as the backbone for transactions?
Terrific question. And actually, I'm a bit of an outlier in terms of my views on this. So let's dig into this for a moment. We'll go first into the retail payment system, domestic US retail payment system, and then into the backbone wholesale payment system, where in Europe you're developing Project Appia. So on the retail side, stablecoins, by the way, are an exceptionally tiny slice of retail domestic US payments today.
Absolutely. I mean, it's 99% US dollar denominated, 1% euro denominated, but the political attention given to it is disproportionate to the size, but precisely because people believe it will be so big in the future.
Yes, but I think they're operating under the misimpression that the growth that we've seen over the last 5 years as a cryptocurrency medium of exchange and store of value and services of collateral will somehow translate into the domestic retail payment system, so that when you make a car payment or pay for a meal at a restaurant or buy a book, that somehow you're going to reach for a stablecoin wallet to make those payments. That's not going to happen at scale. It'll be a fringe activity. And why is that? First of all, it's not a superior payment technology for retail domestic payments. For cross-border, yes. But for retail domestic payments, it's slower, it's more difficult to manage. It doesn't have the backing of the central bank in terms of liquidity provision. It doesn't have deposit insurance. There is some regulation now under the framework of the Genius Act, but it's going to be very slow going. And as it begins to make progress, the commercial banking-based payment systems are going to endogenously react, and they're going to dig deeper moats around bank-railed retail payments.
So that basically it's an incentive for banks to modernize this infrastructure. They do it, then they have all the access, they have the deposits, and they have everything available in order to make that work for their clients, for citizens. That you think will crowd out the demand for stable coins that will be more difficult to manage? Why wouldn't the stablecoin provider also try to catch up with it and offer a similar convenience?
A number of reasons. One is they don't have the network effects, so the incumbent has a big advantage. A second reason is that currently credit cards are dominant and they pay rewards. And recent research by Lulu Wong at Northwestern University shows that if you get an entrant payment system, that those rewards can be used to block the entry. And thirdly, there is a backbone fast payment system called FedNow. In Brazil, the backbone system was turned into a ubiquitous all-to-all retail payment system that's extremely popular. The banks which have been reluctant to let FedNow turn into a retail all-to-all payment system could simply move in that direction and head off stablecoins. Just as in Brazil, I don't think you're going to use stablecoins to make retail payments.
In that regard, I must also say that I see lots of developments in Europe. And interestingly enough, at this stage, the European banks have created a consortium to think about euro-denominated stablecoin, but eventually the chances are in kind of improving the European payment system across the region, not only having super efficient payment systems within countries, but have this fully integrated. And also then, since we are more bank-based than the US, even to think more about what they can do with tokenized deposits and have a combination. And then I think for Europe, I would even agree more with you on the retail side. The need for having stable coins as a means of payment would effectively be much reduced.
Absolutely. Now let me turn to the wholesale side, where currently for tokenized treasury securities, for repo, for margining of derivatives positions and the like, there is a demand for a safe cash leg in tokenized finance in the wholesale market. And there is no stablecoin that is suitable for that application. Now we might say, well, what about USDC? It's a very well regulated, it's safe because it invests in treasury bills and commercial bank deposits. That's completely contrary to accepted principles under CPMI, critical market infrastructure, principles for cash, which are effectively that central bank deposits are the required medium of exchange and payments in the wholesale critical market infrastructure. So, if a USDC were to go in value from $1 to 0.999, which sounds perfectly fine in the retail market, 0.999 on a billion dollar repurchase agreement is totally unacceptable. And not only that, it's a source of financial instability, because if the market understands that there's any weakness, then it will be rejected and there will be disruption in wholesale markets.
Exactly, but isn't then the logical consequence that, in a way, as I understood Andrew Bailey said, if you want to look at like money, we must treat it like money, which would eventually mean that you try to make it safe on a publicly traded platform with all the heavy regulation, but eventually if you want to embark on private money, you also need to give it the backstop of basically the Fed. Would that be the consequence?
Absolutely, either indirectly or directly. So the Fed maybe one day will do what Project Appia is doing in Europe, which is to make central bank deposits available to tokenized finance. In the meantime, in the United States, there are alternative routes, like there could be a narrow bank 100% backed by central bank deposits that issues tokenized deposits for the industry, essentially a bank consortium payment system only for banks. This is not a retail CBDC. Alternatively, we could do what Project Appia is exploring, what the Bank of England has been exploring, which is called synchronization, which means that on a programmable ledger where once perhaps one day we'll be moving from one counterparty to another, the cash side of that transaction will be a movement of traditional central bank deposits in synchrony, conducted by a cryptographic message that allows the movement of central bank deposits, reserves on a traditional ledger. So I think that there are plenty of alternatives that keep the safeness of the unit of account, and you just can't depart from that in a critical market infrastructure.
I agree on this, the safeness of the unit of account. We have actually also worked in that area because we are a bond issuer, and this is critical. The efficiency of that infrastructure is so critically important for us, and we do think that going that avenue of tokenization, of programmability, will a great deal help to increase the efficiency of that market. But then the question is how, and if you do it with CBDC on distributed ledger technology, I mean, it takes away much of the credit risk that you otherwise have. So we indeed also perceive that as a kind of a strategic advantage. And then eventually, and that I find so interesting in what you say, then on both sides of the Atlantic, we will see and have to observe what is the ecosystem that can be created around those different components. And actually, we may see more of a tokenized deposit world in the US than we thought, and maybe more of stablecoins in an ecosystem that has different layers than we had anticipated.
Yeah, it's very hard to anticipate. I'm doing some research on this right now, and I hope to report back to you on the most safe and efficient ways to do wholesale finance on programmable ledgers.
I think we are running up against time, and it has been a wonderful conversation, but what you just said brings me actually to a concluding question to you. You're so in business, if I may say, for decades. Your books have accompanied the development of the financial system. If you would have to think now about the title of a book that you will be writing in, say, 5 years, and given the structural changes in the market, what is the book title?
That's interesting. You should ask Rolf. I'm teaching a course at Stanford called The Future of Money and Payments. That's a sort of working title that could do the job that you just described if I ever get to the project that you just described.
We are very much looking forward to it, Darrell. It was great having you with us. Thanks a lot.
Thank you so much, Rolf. It was a real pleasure to be with you today.
We just had a very interesting discussion on the current state and the future structure of sovereign bond markets in the US and in Europe. There were two main themes that we addressed. The one is the security that sovereign bonds give as a safe haven for the financial system. And here we exchanged views on the changes in investor behavior that we have seen in the recent period and how they infect the investment in US Treasuries and in euro-denominated assets. The second point that we addressed was the digital finance future of sovereign bond markets. And here it was very interesting for me to hear Darrell's view also on the central role of digital currencies and central bank money for the functioning of that market, and the importance that he assigns to a project of a digital euro that actually can help to make those markets much more efficient. For me, it was a very interesting discussion with Darrell on the current state and future structure of bond markets. I very much hope you found it thought-provoking for yourself, and looking forward to see you in a future lunch talk. Thank you.